Before we start, this is general advice in nature. Should you wish to take personal advice, please reach out to your advisor. Welcome to Picture Perspective. My name's Jordan Kennedy. We're fortunate enough today to have a special guest, Ankit Sharma, one of my fellow partners, to talk all things tax planning, year-end. Let's go. So Ankit, before we dive into year-end tax planning, are there some big picture considerations that we need to talk to our clients about?
Great question. I think we, particularly as advisors, spend a lot of time delving into the detail and getting straight to that solution.
100%.
We've got to sometimes step back, chat to the other advisors within and that look after that particular client, such as yourself on the wealth side. Take stock, understand what's happened, and then really have that chat with the client to go, has anything changed in their world? As an example, has a significant asset been realised during the year? If it has, have we considered small business CGT concessions? Have we thought about donations? Have we thought about super contributions and the like, or a combination of all those? If it's a status quo, then really we're probably stepping that through and going, well, are the client goals still the same as they were last time we spoke? What's kind of happening in their lives? Is the structure still fit for purpose? And when I talk about structure, we're talking about trusts, companies, partnerships, super funds, private ancillary funds, all sorts.
Has there been any legislative changes that may have changed the strategy from the prior years as well?
Exactly. And I think there's also that opportunity to step away from the tax for a moment to talk about the estate plans and personal insurances. Are they fit for purpose? Are they right? Has anything changed?
Mm-hmm. I love those topics. You know, every year, hopefully everybody's progressing in wealth, in accumulation of wealth. So super, definitely. Relationships also change. So, you know, all things will, what do you want to, or what are your wishes? Really important.
Do you still speak to the people that are in the will? That's come up a couple of times.
I have had some awkward conversations. Yes. Yeah, I totally agree. And insurances, you know, as we get older and wiser, our wealth accumulates. Do we still need that same level of cover? Does that level of cover still have the same purpose that we originally intended for that to do? So great insights. Yeah. So Ankit, with anything tax, there's always 50 shades of risk. What are the hawkeyes at the tax office got their eyes on this year that we should be specifically mindful of?
So the ATO does a range of webinars. They have their web pages. They conduct a range of reviews across the Australian taxpayer population. And there's a number of things that they're specifically looking at. It's as simple as they have access to cryptocurrency data, they have access to insurance policies for particularly high-end luxury vehicles and boats and the like, as well as the new thing that we're seeing this year is rental property data. So rental agents are providing data to the ATO. The
Airbnb?
Yes, exactly. So there's that whole question of, you got a holiday home, are you correctly claiming the deductions? Are you correctly noting the revenue in your tax return? And particularly investment loans, like, are they 100% for that rental property, or are you sort of claiming some private portions?
So what you're saying is the tax office is getting smarter and they're using that data to come up with better ways to interrogate and check what you're putting in your tax returns.
Exactly. And what we expect is to see more letters from the ATO that are asking really specific details on, you've got this property, you've claimed these deductions, can you please confirm it's been rented and the like. So we're seeing a lot more activity in that space. We're also seeing the ATO being much more stringent on on-time lodgements and on-time payments, to a point where legislation's change 1 July 25, general interest charges will no longer be tax deductible.
Wow, yeah, that's a big one.
That's a big one. I think the ATO's cottoned on that, particularly through the COVID period and the like. A lot of particularly business style clients have been using the ATO
as a form of financier.
Exactly. Yeah. So ATO sort of cottoned onto that. So that's a big area we're seeing that's impacting a number of our clients. Also in the international space, the ATO is getting data from a number of other governments as well. So they've got more data, therefore they can interrogate further and
I've got a lot of friends that still have HECS debts and live on the other side of the world. So that international data matching is becoming quite prevalent, not just at the big end of town, but also at the lower levels as well.
Definitely. And even when you start looking sort of businesses of $10 million plus of revenue, the ATO is starting to become interested in have they met the requirements on residency for subsidiary companies? Have they considered controlled foreign company rules and all those sort of integrity provisions that sit within that space?
Yeah. And when should people start to look at their tax planning and start to digest some of these things? Because you want to leave enough runway to make any changes or to do the things that need to be done.
I think sort of kind of May, June, ideally sooner rather than later, but you need sort of concrete data to be able to make some of these decisions.
Yeah.
So sometimes with an asset sale, I know I've sold that property, I've made a $1 million gain, that was in January.
Let's plan for it.
Ideally, we should be planning for that live at the time of sale, not waiting till mid-June and all of a sudden everyone's sort of in a frazzle trying to solve for that.
You don't want to be running around on the last day to do these things.
Correct. And doing it on the last day does create a whole bunch of issues. So ideally a bit of planning foresight is always a positive, but you don't always have the data till you get to sort of May or June.
Yeah, but you can't, and like good planning comes from having the information, from bringing all your records up to date.
Correct.
Basically knowing what's happened in the year, not just guessing.
Yep.
But having concrete evidence to then tack or build your strategy around.
Yeah, and that's the value of us building the relationship with the advisors that are around our clients as well, because some have that access to the data and you can sort of piggyback off that.
So Ankit, for businesses, we look after a lot of them. What are we specifically talking to them about this year?
I think there's a lot of going back to basics I'm finding with a lot of my clients. So looking at, particularly on the revenue side, invoices are being raised for accounting purposes. Is there an opportunity to consider whether some of those are revenue in advance for tax purposes? Therefore, they're not actually taxable in the year end 30 June 25, primarily because the works or the goods haven't actually been delivered.
Services haven't happened.
Yep, exactly. On the deduction side, have we considered the accounts receivable ledger, and are there any bad debts there?
I love collecting bad debts this time of year.
Yeah, look, ideally you collect it, but worst case, if you can't, then is there an opportunity to write it off because you've done best endeavours and you're just not getting anywhere with that particular client? Review of the depreciation schedule and your fixed asset ledgers to make sure that, look, is there anything that we can claim an instant asset write-off for? Are we still holding all those assets?
Or do we have a new one that we need to do a new schedule for?
Correct. And what are the opportunities around effective life and the claim on depreciation and the like? And then I guess we're also, particularly from superannuation front, super guarantee payments on behalf of staff. One thing to keep in mind, it's on a cash basis. So
yeah, and I'm assuming this time of year, employees get a little bit antsy making sure those contributions are going to drop into the current financial year. So you're sort of making your staff happy, but also making sure you can claim the deduction
and get the tax deduction. So you sort of, when you add those sort of things up, plus looking at inventory, is there anything obsolete? Is there things that can be written off? The combination of those can yield some additional tax deductions at the company level. A couple of other things to consider, maybe a little bit left of field, but research and development grants, are there any government subsidies that the business might be able to access?
Apply for.
Correct. Because I do see year-end tax planning at this time of year as a time of reflection. So it might not be a here and now.
But it could be for next financial year.
What about the future?
Yeah, cool.
Exactly. And I think they're sort of the key things.
And no utes, vans, last minute purchases.
Yeah, look, if it makes sense for the business, it's worth it. But
always has to make sense, not just for a tax deduction.
Exactly. One more thing to consider, particularly from an owner perspective, is the remuneration strategy. So have they taken out cash during the year and not been taxed on it? What does their salaries look like? Does that all kind of make sense? Particularly in the business landscape, Division 7A, which is one of the integrity provisions in the tax rules around loans to shareholders and their associates, becomes sort of front of mind. So I always find it's a useful exercise to really just have that conversation with clients, because Division 7A can be quite nasty if it's not dealt with, but there's also an opportunity to be on the front foot there, and this is a great time to do that.
And I think when you're adjusting or as an owner pivoting between dividend or taking a salary, one thing that always gets forgotten is their super contributions. So, one of the most important super contributions or tax-driven strategies for an owner is to make sure you get that in. So if you have pivoted away from taking a salary from prior years to taking a dividend, making sure you still circle back and tick the boxes.
Exactly. And the other thing that also gets forgotten is the personal insurance piece where, depending on the nature of the policy, not an expert in that space, but just something to be cautious about if you're flicking between wages and dividends.
Yep, good one. So Ankit, talk to us about trusts and investment companies. How do they differ from a trading business, for example?
Different set of considerations. So I think latest ATO stats, there's about 1 million trusts in Australia, so there's quite a few of them. We see trusts probably in two primary guises. One is as an investment accumulation vehicle, and secondly, occasionally for operating businesses. So I think for the purposes of this chat, I'm going to focus on the investment piece. So one key thing, particularly for a trust structure, is to make sure we've got an estimate of the income for the year. Who's that income going to be distributed to? Who are the beneficiaries? And making sure that we've actually sort of documented that. And the documentation needs to meet the requirements of both the trust deed as well as the ATO and legislator requirements. One of the key things, particularly with trust structure, is you want to distribute income out to beneficiaries. Otherwise, the trustee actually pays the top marginal tax rate. So that's something to be cautious of and makes that whole documentation and conversation bit even more important. On the trust income piece, there is that consideration of if significant capital gains have been made during the year, are there corresponding capital losses that could be used to offset those? But first and foremost, that has to be an investment decision, not tax-driven, but a potential opportunity there. A few things to be mindful of, particularly when dealing with trusts and clients that have trusts, are the need to, not only document the strategy, but make sure the beneficiaries receive the benefit of the income.
So the cash flows through.
Exactly. The ATO, one of the areas of interest is this concept of reimbursement agreements, or 100A. A lot of commentary around it. We haven't seen too much practical sort of, reviews from the ATO to really see how they're going to tackle that.
Looking at capital gains within those vehicles as well, and making sure if we've got big gains and losses to realise, is that something else that we run through as well?
Yeah, definitely. And that might require a bit of extra work just to make sure that we've sort of captured all those. But then there's the opportunity of, particularly if there's a significant capital gain that's been realised, are there investments in the portfolio that maybe aren't fit for purpose anymore? That's probably straying more into the wealth advisors territory, but they're sort of live questions at this time of year.
Yeah, great.
The other thing to consider, if we're using an investment company, or call it a corporate beneficiary, to cap the tax rate at 30%, then making sure that those funds are also flowing into that vehicle, because that's another area of our ATO interest. So I think they're, particularly from a trust perspective, but yeah, it's a bit horses for courses, right? Each individual client's circumstance is different.
Yep, exactly. So Ankit, my favourite, the individuals, what's in it for us?
There's always an individual at the top of the family tree. So particularly for the younger members, making sure that if income's over 97,000 and or they're getting close to 31, making sure private health insurance is in place. Otherwise, the Medicare levy surcharge will apply. Donations, make those pre-30 June if that's something that you're interested in. And also, sometimes this is a actual benefit versus a timing benefit, but is there an opportunity to consider deferring income or bringing forward deductions? Probably the last point is making sure that you've got substantiation for whatever you want to claims. So whether that's donation receipts for the AFR and stuff like that, making sure that you've got those ideally prior to 30th of June.
So is this the first warning? Get your records in order, get your things out of the shoebox. Let's get ready for the year end ahead to get your tax return in time.
Yep.
Excellent.
Definitely.
Well, Ankit, really insightful. Always an interesting time of year when we talk tax planning. Thanks for your insights.
Pleasure.